How people pay for healthcare in the US, and more importantly, if people can pay for healthcare, is closely linked to how we financially structure the healthcare system. The US has what's known as a fee-for-service healthcare system, where services are unbundled and paid for separately. So if you go in for a checkup and the doctor orders a blood test and an x-ray, the charges on the bill will be separated into three parts: the x-ray, the lab test for the blood, and the cost of the doctor's time. There are pros and cons to a system like this. It incentivizes doctors to do a lot of tests because they'll get a separate fee for every test, which can be good. You want your doctor to be thorough when you're not feeling well. But a fee-for-service system also incentivizes overtreatment, and this drives up the cost of care. The US also relies on a third-party payer system, which means that medical costs are paid through a third party, like a commercial insurance company that's responsible for paying the doctor on behalf of the patient. Third-party payer systems often rely on cost sharing, where the insured patient pays a little each month whether they need care or not. This helps limit the overall cost to the insurance provider. An insurance premium is the amount you pay to the insurance company each month so that you can keep your coverage. A deductible is the portion of the healthcare cost that you're responsible for yourself before your insurance kicks in. Most insurers offer lower monthly premiums if you accept a higher deductible, so it's kind of a trade-off. Do you want to pay more per month and not have to worry about meeting the deductible, or would you rather pay less per month and worry later when faced with more expensive medical bills? Health insurance exists to protect us from health uncertainty. We don't know if we'll get sick or how expensive being sick will be, making it pretty much impossible to save enough money against the possibility of a very costly illness. So let's go to the thought bubble one last time to discuss how health insurance helps us manage financial risk in the face of a health crisis. Suppose there's a 1 in 50 chance that you'll break your leg and have to pay $7,500 to get an x-ray, a cast, and some physical therapy. You might not be able to dig up that much money. But what if you have 49 other people who are also worried about breaking their leg? If you all agree to chip in $150 to a pool that will go to whichever one of you breaks their leg, you all can rest easy knowing that you won't have to empty your bank account if you fall out of a tree. This is a simple example of a risk pool, a group of individuals who are covered under one insurance plan. An insurance company decides how to set their premiums and deductibles based on how likely the risk is that they'll have to pay out an insurance benefit. Take our broken leg example. What if some of those 50 people were really into extreme sports and actually had a 50% chance of breaking their leg? If the insurance company knows that, they might increase the price that you have to pay into the pool because there's a greater likelihood that more people will need them to shell out $7,500 for a broken leg. Some insurance plans set prices using community rating, in which everyone in the risk pool is charged the same price to buy into the insurance plan. But in the US, insurance plans typically use experience rating, where different groups that have higher or lower risks pay different prices. For example, smokers are at a higher risk for heart disease and lung cancer, so an insurer might charge you higher premiums if you smoke.